Hello everyone, welcome back. I got some really good ones for you today. Markets. We'll start with the US bond market, the debt market, the largest market on planet Earth that has been lately sending out cues to every other market on the earth about how to behave. This last few weeks, we've seen that 10-year yield fall from 3.5% to about 2.5%. That is a substantial move in yields in the debt market. Enough so that when the 10-year yield was about 3.5% and climbing and everyone was freaking out a few weeks ago, we saw the Dow, NASDAQ, S&P got beat up pretty good. That NASDAQ fell as low as like 11,000. However, right when the 10-year yield hit 3.5%, and Kramer came out being a deflationist, saying to abandon high growth tech and go value in dollars and yields and rates, and Robert Shiller was the same, and Elon was the same, and Cardi B was the same, and every banker, economist, and entrepreneur on planet Earth flipped bear. Right when that happened, instead of that 10-year yield continuing to rise, meaning the bond bubble was bursting, and mortgage rates would continue to rise and interest rates would continue to rise, crushing everything, right when everyone thought that that was going to happen a few weeks ago and was even telling everyone on TV and the news it was going to happen, it stopped. The 10-year yield began to reverse to the downside, and when the bond yields start falling and interest rates start falling and the dollar starts falling and inflation stays persistent, that leaves asset prices room to move higher, and we've been seeing that. So little bit of relief rally for risk assets over these last couple weeks, to even include like Bitcoin and precious metals, and pretty much everything has been getting a bit of a boost this last couple weeks. People might be saying, oh, it's because of earnings, or it's because, inflation expectations are doing this, that, or the other. But really what you've been seeing mechanically this last few weeks, in my opinion, is that 10-year yield hit 3.5%. That put mortgages at like 7% in the danger zone. It started to freak out the real estate. It started to freak out the banks with the rising dollar and rising interest rates. And then mysteriously, somebody stepped in, presumably the Federal Reserve, bought bonds and drove those yields back down. When bond yields are falling, that leaves risk assets room to inflate in this environment. So you're seeing that the 10-year yield's hanging out like 2.68, 2.7%. As long as, in my opinion, it stays below 3%, risk assets have room to move higher. To kind of give you an idea of where those price points might be, well, when the 10-year yield was 3.5%, that put Bitcoin way down there in the dumpster at like 19. And on the flip side of that, when the 10-year yield is like 0.65%, Bitcoin's like 60. So if a 10-year yield of 0.65% is putting Bitcoin at 60, and a 10-year yield of 3.5% puts Bitcoin down in the gutter at 18. Now that the 10-year yield is 2.7, kind of in that upper range, but below 3.5, it has some room to move up, and it even went back as high as 25. I'm tentatively bullish Bitcoin, energy, NASDAQ, gold. Why? Because I'm seeing those yields not rising as quickly and aggressively as they should be. And I'm also seeing the Fed not fighting inflation as adequately as they should be. The Fed could have delivered a 1% rate hike at the last meeting. Markets would have handled it because they ripped higher on a 75 basis point hike. So maybe one would have been a little bit too aggressive, but I think after the market slept on it a few days, the market would have said, I see the Fed making a pretty concerted effort to protect the dollar and fight inflation here. I'm pretty optimistic about that. So I think even a 1% move higher to the federal funds rate at the last meeting would have been fine for markets, but the Fed can't even deliver a 1%. They're too scared. So they delivered a 75 basis point, market loved it. Basically, we have a white hot inflation problem right now, and the Fed showing up with a squirt gun. And it's no coincidence that they showed up with a squirt gun. I don't think that's by accident. I don't think they're really as intent on fighting as inflation as they say they are. And I think the market kind of knows this. And I think the market's kind of altering its expectations towards more of a dovish Fed than hawkish one going forward. And the market kind of likes that. So as long as the market sees somebody, Fed or otherwise, buying those bonds, driving those bond yields down, driving that dollar down, driving those borrowing costs down, driving the dollar down and making inflation worse, as long as some major player at the table is doing that, then all the other traders and players at the table look around at each other. They see that stability in the debt market and they're like, well, I'll get long some risk assets. And in the back of their mind, they know inflation's a big problem. And the Fed's probably never going to raise their Fed funds rate above the inflation rate to effectively break the back of inflation anyway. So as long as the Fed shows up to the inflation fire with a squirt gun and promises to roll off his balance sheet but doesn't, and promises to raise interest rates and borrowing costs and bond yields but doesn't, well, then markets have room to inflate, and you're kind of seeing that. If the Fed really wanted to fix the inflation problem, they could even do it with expectations. They could just say tomorrow, hey, I'm not even necessarily going to do this, but let's just float the idea of a 1 or 2% rate hike, and the markets would just start to deflate, and the dollar would go up in value immediately. So Fed can't do that. Fed doesn't want to do that. Fed likes baby rate hikes. I suspect more baby rate hikes coming or none at all. So I would either expect in the next 12 months for the Fed to take some of these rate hikes off the table that they have planned, or make them smaller. So where they would have maybe done or should have done a 1%, they'll do a 75. Maybe where they should have done a 75, they're going to go 50. Maybe when they should be doing a 50 basis point increase to the Fed funds, they're going to opt for 25. And the reason for that is if they can drag their heels and always under deliver on interest rate hike expectations, that leaves risk assets room to inflate. And it's my personal belief that the Fed wants to protect that system. If the Fed wanted to cause a debt detox and falling demand and bring free market forces back to all markets in full swing, they could do that, but they don't. So I expect some of these rate hikes to come off the table. Even if they don't, they're going to end up being smaller. And as long as the Fed is raising interest rates only 0.25% or 25 basis points for every 1% inflation we get hit with, will asset prices have room to move higher? So just my thoughts on that. We're seeing, all eyes on that 10-year yield. If you think interest rates, bond yields, and the dollar are going to move higher, then you're going to want to stay away from risk assets like Bitcoin, oil, NASDAQ, gold. If you think bond yields are going to stay stable or move lower, then you want to hold risk assets like NASDAQ, Bitcoin, oil, gold. We'll talk about gold because we haven't, honestly, in a long time. So gold hanging out around 1790 right now. I'm bullish. I think gold will continue to do the cost of capital, just my opinion, not a buy or sell recommendation. And to be honest, gold is stable. It's not a security, right? We've talked, it's not an investment. It doesn't pay a dividend. You can't cash flow it, but you buy those non-productive clumps of atoms. Cause I say, stay away from derivatives, stay away from mining stocks, stay away from those gold indexes and even the GLD and SLVs, like those paper derivatives that track the physical price. Stay away from all that. If you're going to buy precious metals, I would go physical, but again, it's not for everybody, and just do you. But I would go strictly physical. Also, you're always like, well, when? Okay, as long as real interest rates are negative. So as long as real interest rates are negative, never mind the nominal rate. So I care what the interest rate when you factor in inflation. As long as real interest rates are negative, I buy the dips on gold. And if real interest rates are positive, or I think they're about to move positive, I sell gold. But I've told you, I don't think interest rates are going to be positive, especially not in real terms. They might continue to be positive in nominal terms, meaning the Fed continues to raise interest rates incrementally as we go through the next couple of years. So 25 basis points, 50 basis points, those are nominal increases. But if the backdrop of inflation remains horrible or even gets worse, you have to factor in inflation in order to get the real interest rate. So when real interest rates are negative, you buy the dips on gold, and when real interest rates are positive, you go short and fade the rips. That's like your down and dirty ABC of trading gold. I like it at 1790, but also I don't really get too caught up in prices, just if when you can kind of thing. It's always there for you. You're not going to get rich buying it, but you're not going to lose anything either, because gold is a store of value, and all the gold price does is mirror the amount of credit and counterparty risks that are in the system. So even when the gold price is falling, you're fine. It just means dollars are becoming a little bit more valuable, but it's a game of ounces. As long as you continue to acquire over the long term, you're fine, and you just stick to physical. One thing I like too is platinum. Platinum's kind of weird, not a monetary metal. It is a little bit, but it's more of an industrial metal, but still good, especially with the amount of platinum there is above ground. It's crazy. All the gold ever mined would fill 3 Olympic-sized swimming pools, and platinum would only fill to your ankles on 1. So there's not a lot of this stuff. Super scarce, super rare as far as crustal abundance is concerned, and has really good industrial application too. It has its needs. They use it in catalytic converters. Platinum's in there. It shares a lot of the same qualities as gold. It's not money, okay? Platinum is not a tier 1 asset to the banking system like gold is. Gold was really chosen to be that. So if you ask an institutional banker what they like in the precious metal space, they'll begrudgingly tell you they like gold, because low-key bankers, they hoard gold, but they hate it, okay? Because it's non-productive clumps of atoms benchmark that they compete against. And if you leave a gold coin just sitting on a desk, it's not going to do jumping jacks work, break a sweat, create a profit. And so banks really don't like losing against that stuff as far as benchmarks are concerned, okay? Imagine working 80 hours a week and you're busting your butt for your clients, and your fund does 8% that year, which is fine, and then gold does 14. In real terms, your fund is actually going bust. And so the banking sphere never wants to see non-productive clumps of atoms that you just plunder the earth. And also they don't like it because gold doesn't have counterparty, so you're not hiring anyone to do anything. I mean, yeah, there are the people, the mine engineers and the people that worked at the mine, but they're selling you work that's already done, and bankers hate that stuff. Bankers like selling work that's going to be done in the form of counterparties and investment and promises. They don't like the break glass in case of emergency safe haven that gold is. So banks will say begrudgingly, I like gold, and then they'll probably kick silver and platinum to the curb. And then rhodium and palladium especially, these other platinum groups and precious metals, they just really don't like. Gold is the money, okay, to them. But again, gold doesn't have any counterparty risk. It's not an investment. They don't like it because they compete against it. So they don't like it, but they'll hoard it, if that makes sense. So that's kind of your thing on gold. I like it here at 1790. I think it'll do the cost of capital. I'm not one of those guys that's like, oh, gold's going to go into a Bitcoin type bubble. I don't really buy it for speculation at all. It's more like to me, just my opinion, a super powered savings account. And the reason for that is because what has your savings account been paying since you were, in high school? Practically nothing, right? At least for me, I don't think savings accounts my entire life have ever been like more than 2%. And if every year you're getting paid less than 2% on your savings account, but inflation is 2% or more, you're losing in real terms. So I say, okay, instead of saving in dollars, like having this big savings account which just sits in dollars, maybe consider turning that into like, physical gold or something like that. Not because it's going to pay an interest, because it's not going to. It's a non-productive atom. But because it's going to do the cost of capital. So every time 20% gets added to the money supply, gold is going to take the ride along, even if banks don't want it to. But we'll talk about bank manipulation in the London fix some other time. I like gold, not as speculation though. So as long as real interest rates are negative, I'm just like, yeah, buy some gold. That's kind of my attitude about it. And I like silver too. Silver's awesome. And I like platinum. We talked about that. I really like platinum. Super scarce, super rare. So could be something there. What else is going on? Bitcoin's like 22, 23 right now. It's getting the help from that falling 10-year yield. A 10-year yield of 3.5% really freaked out Bitcoin. But now that 10-year yield's down to 2.7%, giving Bitcoin a little breathing room. I like to see that. Same goes for the growth stocks and NASDAQ. Likes to see that 10-year yield moving lower. And energy. So last time I checked, WTI crude's about 88 a barrel. I have a $250, $350 price target on crude over the next 4 to 6 years. So it wouldn't surprise me to see it get there. So could oil fall from where it's at now, 88 down to 80, and hang out in the 80, 85 range? Sure, it could. There's a lot of traders saying that it could, but grand scheme of things, I have a very, very high price target for oil. BlackRock getting in bed with Coinbase, that's really interesting. So BlackRock is partnering up with Coinbase. You might be thinking, hey, Bitcoin at 20 is still way too expensive for my taste. I want to see it like at 6. I want to see it at like 7. But you might not get that because we live in a different world now. The institutions showed up to the crypto space in October 2020, and I don't see them leaving like ever. So if this space is going to continue to get built out and mature and develop, I think Coinbase, and not a buy or sell recommendation, I'm just pointing over there, like just look at Coinbase, and that is a stock, a publicly traded company. Obviously I like Bitcoin, we've talked about that. I like some of the other alts like Solana, Avalanche, Algorand, not to get too into that, but BlackRock and Bitcoin are in bed with each other. So hey, BlackRock, largest asset manager on planet Earth, building out their whole crypto trading, and as well as allocating for themselves, I'm sure of it. So there you go, constructive things happening in the crypto space, even given this bear market. That's kind of cool. And I'm really optimistic on the future for crypto. So hey, we're just gonna have to see. Really, one more thing and then I'll let you go. Nancy Pelosi did her little meeting in Taiwan. She met with Taiwan semiconductor manufacturing company. They're looking to open a multi-billion-dollar plant in Arizona, potentially. So look, Pelosi's doing some weird stuff, all right? She bought a bunch of NVIDIA stock, like 25,000 shares a few weeks ago, got this $52 billion chip bill passed, then came under public scrutiny for owning all these NVIDIA shares, dumped them, but still has NVIDIA calls, and then goes over to Taiwan and starts talking to all these chip companies. So, it smells fishy, all right? You can go on Twitter and look up Pelosi stock tracker, and it just shows all, what she's buying and selling. She's just flying around, saber rattling and insider trading, I guess. And it's all for her. I don't really like to see the tensions building up in Taiwan and China. I've been watching those tensions build now for over a decade. I spent 6 months in Japan, a couple months in South Korea, so I kind of know what the situation is over there. And it's continuing to get tenser and tenser. And then you have these insider trader weird old ladies that should have left. She's been in power for like 1,000 years, and they're just going in doing their little thing, moving and shaking. We really got to get a handle on regulating our politicians and policymakers, because I smell insider trading. But I could totally be wrong, and I don't want to make this like libel and slander. And it isn't political. She's just objectively too old to be doing that job. I don't know why we're picking her to go over there and be the spokesperson for the empire that is facing a potential war. And then all this chip deals, and Taiwan is a huge chip maker. Insider trading type. It's just kind of disgusting. But hey, I don't want to have a meltdown, and so it just kind of is what it is. So that's really all I got for right now. And yeah, I'll be back, and we'll just keep going. All right, like always, we'll be okay. We'll keep going. Watch that 10-year yield. Lower means risk assets move higher. 10-year yield moves higher means risk assets move lower. That's like a really good starting point. And then you can see how interest rates, mortgage rates, the dollar move, and then you can look around at the risk assets and see how they're moving. So that's just kind of what I see. Like, subscribe, comment. I'm really excited to hear your thoughts. And till next time.